The 1099 DA is a new tax form the taxpayers are going to start receiving in January of 2026, next year. What is it? What should you be concerned about? Well, the 1099 DA, the DA stands for digital assets, is like other 1099s. It reports back to the IRS all your transactions that involve sale or transfer of assets. Now, it's not reporting the purchases because that's not a taxable event. How should you feel about this? Well, first of all, these forms will start to come from centralized exchanges that have a tie to the US. So we're talking Coinbase, Kraken, Gemini, Uphold, Robinhood, Fidelity, Franklin Templeton, Swan. Anybody that has a US tie, the exchange is going to start to generate these. Who gets a 1099 DA? Anybody who has sold or transferred assets from their centralized crypto exchange in the US is going to get a 1099 DA. People who are using DEXs, DeFi activity, are not going to be getting ones because they do not have the same reporting responsibility that the centralized exchanges have. Why does it matter? Well, the 1099 DA is going to be a direct pipeline of information to the IRS on your trading activity on that exchange. They're going to see every sale activity that you have, every transfer activity that you have. When you're transferring to, say, another hard wallet, they're going to see that. They're going to see the wallet addresses. They're going to see exactly what it was you sold. Now, the timeline on how this is going to be worked out. The first 1099 DAs will come out in the January, February time period of 2026. It'll be for the 2025 tax year. In order to give the exchanges time to make modifications to their systems, it's only going to report the value of the sales, the proceeds, if you will. It will not, in the first year, be reporting the cost of those transactions, what you paid for. So it's just going to be big numbers sent to the IRS. And the IRS will have no idea if these were profitable or not. They're just going to be big numbers. They're going to list every single trade and transfer that you had on there. Now, in subsequent years, and starting in 2027, they will list the cost basis if the exchange knows what it is, which is not always going to be the case. Why is it important? Because it's also giving to the IRS the wallet addresses that your funds are being transferred to. So, for example, you buy $1,000 of Bitcoin on Coinbase. You then transfer that $1,000 of Bitcoin to your Bitcoin wallet on your ledger. That wallet address will be reported to the IRS. They will know that you have an address. They won't know it's your personal ledger, but they'll know about it. This then gives them information later, if they choose to act on it, to look at that wallet address, start to trace movements from that wallet to other wallets, and start to, as you can see, paint a picture of your whole portfolio holding in terms of how many wallets and addresses you have. And this will be not just for Bitcoin, but all coins that you trade. So this is a tremendous pipeline of information that over a several year period is going to give the IRS the capacity to have a very detailed view of your entire crypto holdings. That's why it's important. Risk of inaction. What should you do? Well, this is going to cause some really big problems, these 1099 DAs, because it's imperative that you report the 1099 DA on your tax return, regardless of the information that's on there. If you fail to report it when you're preparing the tax return, whether it's you or your accountant or the tax software you use, when you report a 1099 to the software, when it's electronically filed, it clicks with the IRS that you accounted for that 1099. Now, if you don't report it on your tax return, at some point in time, the IRS is going to say, hey, you didn't report this 1099 DA. We think you owe us some money. We're just going to calculate the tax and send you a bill. This is not a good way to go. It's called a CP 2000 notice, where they're going to harvest unreported income. So it's very important for you to report your 1099s, even though you don't agree with the numbers. In a separate video, we'll tell you about how to subtract that off. But it's important that you protect yourself and account for all these 1099s on your tax return. It's going to be very scary, I think, the tax year that's coming up, just for that reason. If you don't report it, you're going to end up on the IRS's short list of people they're watching for cryptocurrency underreporting of income. So you don't want that because that's just the beginning of a nightmare. Privacy and surveillance. There's been massive protests and complaints about the fact that wallet addresses are being disclosed in this 1099 DA. But the IRS has determined, in their opinion, that a wallet address itself is not something that is of great exposure. They feel that the data being transferred to them is being transferred in a secure way and it's being kept, even though it's part of your identity, they're keeping it private. So you can trust the government to keep your information private, right? So that's the concern people have. Over time, they're going to have an immense picture of all your wallet addresses, or from them, build a picture of what your whole portfolio looks like. What happens if you have assets on an offshore wallet? So here's what's happening. I buy cryptocurrency on Coinbase. Coinbase does not report that on a 1099 DA because it's not a taxable event. You then transfer that Bitcoin to your private wallet. That will be reported on a 1099 DA. It'll be reported not as a taxable event, but as a transfer. It's not clear to the IRS whose wallet that is, so it may be that transfer is some payout to other people. You'll have to explain it on your tax return. Later, I have this asset, this crypto on my wallet. I then transfer it, say, to a different exchange. Let's call it Kraken. I transferred incomes, some cryptocurrencies to Kraken. Kraken will report that to the IRS. They will report the deposit of so much crypto from and specify your wallet. So that's how the IRS is going to get information on that. They will not consider that necessarily a taxable event, but it'll be a possible taxable event. Then, let's say you sell that cryptocurrency on Kraken, the sale event on Kraken will be reported to the IRS. Since they do not know what the cost basis was of that, it'll be left blank. So that's kind of the life cycle of how your different transactions are going to be reported on a 1099 DA. As you can see, this is a massive information grab from the IRS, and people are going to be shocked when they start to realize this. How does this affect owners and miners? At this current time, mining activity is generally done privately, so that's not reported, would not be reported. If you're using a service, a mining service, farm service, then that service would probably have an obligation to report that 1099 DA that you had mining income. If you're a validator, you may or may not have reporting obligations to the U.S. government, depending upon how you're incorporated or operate. But chances are, since you're the one generating the rewards coming out of it, I don't think there's going to be a 1099 DA created by you, but you might have a legal obligation to file one for other people. That remains to be seen. What can you do right now to prepare for the 1099 DA? Well, let's talk about this. If you're a simple investor, if you keep all your cryptos on one exchange, let's say Coinbase, and you do all your trading from Coinbase, you never move it off of Coinbase, you never use a private wallet, everything you do is on Coinbase, then the benefit of this method is that Coinbase will know what the cost basis is, and it will report that in future years to the IRS, what you sold it for, what you bought it for, what the profit was, and then eventually you just take that profit, write it on your tax return, and you're done. This is how stock traders do it right now. They have a 1099B. Stock traders don't move stocks around once they buy them. They stay and they live, and then they get sold on that same brokerage. So the 1099 is very good at reporting profits. It's very helpful for preparing a tax return. But the typical crypto investor moving things around, keeping private wallets, it's just creating a nightmare. It's going to be very complicated doing a tax year. Follow our advice on our channel, give you tips on how to report, not just do your gain calculation, which is a whole new process for 25, but also how to report that on your tax return. It's going to be a significantly different process.